All right, today we are digging into one of the biggest questions an investor can ask. If you had to put your money into just one single stock for the next year, what would it be? Well, we've looked into an analysis that has a really surprising answer, and it comes from the playbook of the master himself, Warren Buffett.
So let's make this real for a second. Imagine you had to take your savings and go all in on just one company for the long haul. That's the ultimate investing gut check, right? It forces you to completely tune out the noise, the hype, and focus on what actually matters: stability, durability, and just plain real-world value.
And here's where it gets interesting. The answer we're going to uncover today, it is not one of the usual suspects. It's not Apple, even with its incredible dominance. It's not Amazon and its massive, untouchable moats. And it's definitely not one of the high-flying AI stocks that are all over the news. Nope. We are going way off the beaten path to find something built to last.
You gotta love this classic Buffett quote. It just perfectly captures that feeling of being completely overwhelmed when the market is in a panic. Think about it. Back in the brutal bear market of 1973, he was seeing amazing companies on sale for pennies on the dollar everywhere he looked. But while everyone else was totally frozen with fear, paralyzed by the headlines, Buffett was ready to go shopping. He saw the bargains right in front of his face.
And that feeling leads to what this analysis calls the cocktail party phenomenon. You know exactly what this is. You go to a party and everyone wants to brag about the hot new stock that just shot to the moon. Nobody wants to talk about their boring, old, dependable company that just quietly makes them richer year after year. But that's the secret. That's exactly where the real opportunities are hiding.
Okay, so if we're supposed to just ignore all that cocktail party chatter, how in the world do we find these boring but brilliant companies? Well, the key is to have a disciplined framework. So let's break down the 4 timeless principles Buffett uses to cut right through all the noise.
And here they are. It's a 4-pillar framework and it's brilliant. First, the business has to be simple. So simple you could explain how it makes money to a 10-year-old. No confusing tech, no financial wizardry. Second, it needs a moat, a durable competitive advantage that keeps competitors away. Third, you need incredible managers who think like owners. And finally, you have to buy it at an attractive price. You need that margin of safety.
Let's just focus on that moat idea for a second, because it's so important. Think of it as the company's defense system. It could be a powerful brand that people are fiercely loyal to, like Coca-Cola. It could be super high switching costs that lock customers in, like a payroll company. Or it could just be massive cost advantages, like Walmart, that smaller guys just can't compete with. A wide moat means a safe investment.
All right, so we've got the 4-pillar framework burned into our minds, which means it's time. It's time for the big reveal of the one stock that, according to this analysis, fits every single one of those criteria for 2025.
And the pick is Johnson & Johnson. Now, I can literally hear what some of you are thinking. J&J? Come on, that's boring. And you know what? That's the whole point. Its predictability, its lack of crazy hype, that's exactly what makes it such a powerful investment, according to this deep dive.
So why Johnson & Johnson? Does it really hold up to that tough framework? Let's put it to the test, and we'll go through it pillar by pillar.
Pillar number 1. Is it a simple business? Absolutely. J&J basically lives in 3 worlds. Pharmaceuticals, if you get sick, you might take their medicine. Medical devices, if you need surgery, the doctor's probably using their tools. And consumer health, think Band-Aids, Tylenol, stuff that's in your bathroom right now. It makes money from permanent, unchanging human needs.
And this just perfectly illustrates the power of that model. Think back to the 2008 financial crisis. The world was falling apart, and the S&P 500's earnings fell off a cliff. But Johnson & Johnson's earnings? They actually grew. People cut back on new cars, they cut back on vacations, but they did not and could not cut back on their life-saving medicine.
Now here's a number that really speaks to its incredible moat and management: 67. That is 67 straight years of increasing its dividend. Think of everything that's happened in the last 67 years: recessions, wars, market crashes, and through it all, they just kept giving more cash back to their owners. That's a business model that is just unbelievably durable.
And the story gets even better. The analysis points to 3 huge catalysts that Wall Street might be missing. First, demographics. The population is aging, which means demand for healthcare is pretty much locked in to grow for decades. Second, innovation. They spend over $12 billion a year on R&D, which keeps their pipeline full of new treatments. And third, a potential spin-off of their consumer division could unlock a ton of hidden value for shareholders.
Let's just put this in perspective. Compare it to a phenomenal company like Apple. J&J sells necessities. Apple sells discretionary goods. In a recession, you might put off buying that new iPhone, but you are not going to put off taking your heart medicine. That makes J&J's demand incredibly stable.
So what about all those hyped-up AI stocks? Well, betting on a revolution like that means you have to predict the technology, the timing, and the ultimate winner. That's like trying to hit 3 moving targets at once. Investing in J&J, that requires no complex predictions. The bet is that people will still get sick and will still need healthcare. It's a bet on a predictable certainty.
Okay, so we've covered the what and the why, but how do you actually apply this stuff? Let's turn this whole idea into a real-world strategy you can actually use.
The source material shares this amazing story about a doctor who just invested $5,000 a year every single year into Johnson & Johnson stock. He didn't try to time the market, he didn't get fancy, he just bought consistently. And by the time he retired, that position was worth over $2 million. That right there is the pure magic of compounding in a world-class business.
So here's a simple, actionable game plan. Number 1, start small. Get comfortable with it. Number 2, add to your position over time, especially when the market is freaking out and the price is lower. See it as a sale. 3, reinvest every single dividend you get to let that compounding go to work. And number 4, this is the hardest one, just ignore the daily noise. Ignore the talking heads and focus on the long term.
And this all builds to one final really powerful takeaway. Because we're not just talking about a stock for 2025 here. We're talking about the idea of finding a permanent investment.
The analysis ends with this really touching story about visiting a children's hospital and just seeing the J&J logo everywhere, on the surgical tools, on the bandages, on the medications. And the person had this realization. They weren't just looking at a company that sells products. They were looking at a company that is deeply, fundamentally woven into the very fabric of human care.
And that leaves us with this one big, provocative question. Forget the hype, forget all the trends. In a world that's constantly changing, is it possible that the best investment you can make is one that is simply indispensable? Definitely something to think about.